Some of the most highly valued private companies in the world, spanning aerospace, artificial intelligence, and advanced technology, are preparing to enter the public markets. SpaceX alone holds an estimated valuation of $1.75 trillion, a figure that places it among the largest corporate entities on Earth before it ever lists a single public share. For decades, the foundational promise of index funds has been simple and efficient. They are designed to objectively capture the broad returns of the public stock market while keeping fees and friction as low as possible. But because their primary mandate is strict market representation, index funds operate on rigid rulebooks. If a company lists and meets the criteria for a major index, passive funds tracking that index are mechanically forced to buy the stock. The problem is that companies and early insiders dictate the timing of an IPO. They choose to list their shares on the secondary market at the exact moment they believe the equity is fully valued or even overvalued. When an unoptimized trillion-dollar listing is forced into the market, we see the creation of a shadow tax. By mapping the exact microstructure of how these stocks are included in indices, we see how mandated, price-insensitive buying turns passive index funds into exit liquidity for early insiders. The mechanical rules originally designed to make index investing safe, objective, and predictable are now mathematically forcing these funds into disastrous market timing. To understand exactly how this capital is extracted, we have to look at how different indices govern new listings. The S&P 500, for example, historically requires a stock to trade on a public exchange for a full 12 months before inclusion, allowing the market to find a fair price. But total market indices, like the CRSP US Total Market Index tracked by massive funds like VTI, use a mechanism called fast-track entry. If an IPO meets certain criteria, it is added to the index in as few as 5 days. This creates an immediate structural vulnerability. Because the inclusion rules are entirely public, financial intermediaries like hedge funds know the exact date the index fund is mandated to buy, and they know the fund has no discretion over the price. This chart compares standard inclusion against fast-track entry. Intermediaries acquire shares immediately, anticipating forced passive capital. Expected demand causes fast-track IPOs to outperform by over 5%, peaking on inclusion date. As index funds execute mandatory purchases, intermediaries exit and the price mean reverts within 2 weeks. Index funds are paying a systemic multi-percentage point premium to Wall Street intermediaries solely because of the rigidity of their own rulebooks. This front-running dynamic becomes even more severe when we factor in the specific equity structure proposed for these upcoming listings. We have to factor in the concept of free float, which is the actual proportion of a company's total shares that are made available for trading on the public secondary market. This diagram shows the artificial constraint. Entities like SpaceX plan to float less than 5% of equity. Out of $1.75 trillion, only 88 billion trades. Most indices weight by public float. Listing a low-float giant directs massive capital into a tiny, restricted supply. Recognizing the sheer scale of these impending IPOs, major exchanges are currently altering their rulebooks. NASDAQ recently approved changes to speed up inclusion and eliminate their minimum float cutoff entirely, specifically to win the listing business of these private giants. Securing the listing generates substantial fees for the exchange and highly favorable liquidity for the early corporate insiders. The cost is absorbed entirely by the index fund investors who are forced to buy into the constrained supply. Forcing trillions of dollars of passive capital to chase an artificially restricted 5% equity supply engineers a structural pricing bubble. Beyond the immediate mechanics of index inclusion, we need to examine the long-term empirical performance of these equities once they trade on the secondary market. The consistent underperformance of newly listed stock is a well-documented financial phenomenon known as the new issues puzzle. Historical data shows that IPO investors receive average returns of only 5% per year, while established listed firms return 12. Out of 11 examples, 10 severely underperformed the broader market within 3 years, averaging a 50% drop from their offer price. This historical failure rate of low-float listings becomes even more concerning when placed next to the astronomical valuation metrics currently attached to today's private megacaps. If SpaceX lists at its projected valuation, it would carry a price-to-sales ratio of more than 100 times. For context, the highest ratio for any S&P 500 constituent today is Palantir at 73 times, while the broader index trades at just 3.1. Acquiring these highly constrained equities at triple-digit sales multiples is a mathematically proven wealth destroyer for passive portfolios. Given the structural tax of index inclusion, a rational investor might look for ways to bypass the public market entirely and secure private shares before the IPO. This demand has led to a proliferation of special purpose vehicles, or SPVs, alongside crossover ETFs that attempt to package private equity stakes for retail investors. However, the financial intermediaries constructing these vehicles extract extreme compensation for the access. It is common to see structures carrying a 4% upfront cost, paired with a 25% fee on all future profits. Furthermore, wrapping a highly illiquid asset, like a private SPV contract, inside a liquid publicly traded ETF creates severe practical friction and pricing deviations. We have already seen real-world examples of this failing. Certain crossover ETFs that purchase stakes in these massive private tech companies actually lost money in absolute terms, even as the underlying private company's reported valuation rose substantially. Attempting to front-run an IPO as a retail investor almost always ends with the financial intermediaries absorbing the upside through fees, leaving the investor with all of the structural risk. This brings the issue back to the central victim of this market microstructure, the standard hands-off index fund investor. This flowchart maps the mechanical sequence. Insiders choose to list when valuations are high. Exchanges fast-track the low-float IPOs. Passive funds are forced to buy at peak prices, and the stock immediately suffers mean reversion. This cycle of forced market timing creates a measurable aggregate performance track, calculated at between 47 and 70 basis points per year across the tracking portfolio. But you do not have to accept the shadow tax. Asset managers like Dimensional utilize funds that offer the same low-cost, broad market diversification as index funds, but they reject the rigid rulebooks that force mechanical buying. By intentionally delaying the inclusion of new IPOs for a year, these funds completely bypass the hedge fund front-running premium and avoid the initial volatility of junk growth pricing. True wealth preservation requires abandoning strategies that prioritize strict index tracking over actual expected returns. By stepping away from the rigid rules, you can let the active intermediaries fight over the initial listing and enter the market only when true price discovery is complete.